The US stock market has dropped by almost 6% from its highs this year, while the Nasdaq fell a little more than that. Meanwhile, many of the tech stocks, which were supposed to be leading the bull run, have also fallen by quite a bit. For example, Nvidia lost over 20% of its value from its peak, Palantir 32%, and the worst of them all, Tesla, which has fallen by 43%. Ouch! But didn't many analysts including Permabull Tom Lee say that 2025 will be a great year? Especially during the first half of the year? Interestingly, even after this 6% drop, Tom Lee is still very bullish, as it calls this drop a flash wound, and the markets could even bottom by this week. But whether he will end up being right or not, time will only tell, yeah? In this video, I will explain what is causing the markets to drop by so much over these past few weeks. I will show you how much further it can drop using historical data, and finally, what I think is the right way to invest now. So the first reason as to why the market is going down is because of tariffs. But wait, didn't Trump agree to pause tariffs back then? Well, not really, because there's a lot ding dong here and there, because Trump is very unpredictable. So back in February, Trump threatened to impose tariffs on 3 of their largest trading partners, Canada, China, and Mexico. But after a few phone calls with Canada and Mexico, he agreed to pause the tariffs for 30 days after they had agreed to his demands on addressing the fentanyl problem. As for China, that's 10% tariffs for them, which of course causes them to impose their own retaliatory tariffs as well. 30 days have passed since then, and Trump is now back again, with him slapping on 25% tariffs on imports from Canada and Mexico, as well as another 10% tariffs on Chinese imports. As you might imagine, all 3 countries will be retaliating back, to which Donald Trump responds to Canada with a tweet. If you retaliate back, we will retaliate back even harder. As of today, Trump decided to pause tariffs on cars from Mexico and Canada by 1 month. So the whole situation is developing very fast, and with Trump being reluctant to negotiate on any deals, I'm not going to lie, we could see this situation becoming a lot worse in months to come. Next, the second reason as to why the market is going down is because of recession fears. What? Recession fears again? Yes, again. So a few days ago, the Federal Reserve Bank of Atlanta released a report showing that they now estimate GDP for the latest quarter to be negative. So just 2 weeks ago in February, the expected GDP was 2.3%, and by 28 February, it dropped to negative 1.5%. Then after the latest data came out, it further dropped to negative 2.8%. However, before everyone be like panic it's important to understand why GDP now has dropped into the negative territory. If you look at the GDP breakdown, the main reason that contributed to this drop is because imports have increased by quite a bit recently. So whenever a country exports something, it generates income from outside the country. So exporting will contribute to the country's GDP. But when a country imports something, it subtracts from the GDP. So what happened was that because of Trump tariffs threat, many companies in the US have been quickly importing a lot of goods before the tariffs take place. This caused imports to rise, which caused the GDP reading to drop into the negative territory. While this trade deficit is just a temporary thing, there are now many other signs that are pointing to a slowdown. For example, US consumer confidence has just posted the biggest drop in over 3 years. US consumers cut spending in January by the most since 4 years ago. Private businesses have added much fewer jobs than expected last month, while the unemployment claims have quadrupled this year, partially thanks to DOGE laying off federal workers. And inflation expectation is starting to creep back up, which oftentimes is a bad thing, because it can lead to a self-fulfilling cycle, which will eventually cause inflation to go back up. By investing a fixed amount regularly through a regular savings plan, you can dollar cost average buying more units when prices are low and fewer when prices are high. This helps to smooth out market fluctuations and reduce risk over time. For that, you can check out USmart. In celebration of USmart's 7th anniversary, USmart is introducing a zero-cost regular savings plan. This lets you dollar cost average into eligible US and Singapore stocks and ETFs with zero commission, zero platform fees, zero custodian fees, and 0 exchange fees, giving you a smarter way to invest. To enjoy this promo, all you need to do is open the USmart app, tap on Trade Regular Savings Plan, and select the stocks that you want to invest. And here, you can start investing with as little as $100. USmart also offers the convenience of setting up automatic e-Giro deductions directly from your bank account. So you can skip the hassle of manual transfers every time. You can then choose your preferred investment frequency from every trading day to every month. As part of their 7th anniversary celebration, new users who sign up with USmart now will receive up to $202 worth of welcome gifts, including Tesla share vouchers, cash vouchers, free US and Singapore markets live pricing when you fulfill the terms and conditions. So if you are interested, sign up for USmart using my link down below to take advantage of this exclusive offer. Let's get back to the video. Now, because of all this bad news, the market now believes that the Fed will cut rates by as much as 3 times this year, which could potentially bring rates from the 425 to 450 basis points to the 350 to 375 basis points. However, the Fed may increasingly find itself stuck between a rock and a hard place. Because on one hand, if the Fed cut rates, Trump's tariff plans may lead to higher inflation, which is bad for the economy. But on the other hand, if the economy is slowing down and the Fed doesn't cut rates, the economy may enter into a recession, or even worse, a stagflation, where both the inflation and unemployment rates are high. Which brings us to the question, how far can the market drop this time? First things first, to be fair, I believe that the market drop, while it looks scary, is actually a healthy correction. That's because before this drop, the S&P 500 was already in the overvalued territory for quite some time, and many stocks were seeing crazy valuations like your Palantir, Nvidia, and yes, Tesla. Though, even after this drop, many of them are still quite overvalued, like Palantir at 477 PE ratio. It has just gone from the woohoo, I'm on the moon super overvalued to wee, I'm still very overvalued. In fact, a 5 to 6% drop is quite a common occurrence, as on average, we will see a 5% drop or more about 3 times in a given year. But as to how far the market can drop, if we look back at 2018, when Donald Trump started introducing tariffs, the S&P 500 fell by a whopping 20%. And that time, the tariffs targeted only a few imports as well as only China. So now, this tariff is definitely a lot bigger than last time. However, this doesn't mean that the markets will crash as hard as last time. But it also doesn't mean it won't. It all depends on how Trump wants to do it. But what we do know are 2 things. One, during his first term, Trump actually measures his success based on how well the stock market did. So for all we know, he may be playing 4D chess here, where he is introducing short-term pain to get long-term gain. Second, Trump likes to be the popular guy, and the polls show that less Americans are in favor of tariffs on Canada, Mexico, and Europe, as compared to tariffs on China. So there's still a possibility that he might only be using his tariffs as a bargaining chip to accomplish something else, and he might not go as far as what many people fear. But whatever his plans are, I think none of them matter to us, because we can't control what Trump does ma. And if the market crashes because of what he did, let it crash lor. Because believe it or not, there's more money to be made when you invest during a crash rather than during a bull run. Like, will you rather buy stocks at all-time highs where you don't know how much further the stock will go before the next crash? Or will you rather buy stocks when it's 50% cheaper and make tons of money when they recover? But don't we also lose a lot of money during market crashes? Yes, but if you are long-term investors, it's important to remember that market crashes are inevitable and are part of your investing journey. If you are investing for 10, 20, 30 or even 40 years, we will definitely encounter a number of crashes along the way. And if they happen, they are a gift. They are a gift for you to make more money and not something to be scared of. It's also worth remembering that market downturns, while scary, only last for a very short time, while bull markets tend to be a lot longer. Like, even if you had very sway invested right at the peak of 2018 before the crash, you would have still made gains if you had just held on and do nothing for 1 year. But of course, this is just cherry picking data, right? because there are a number of times where the US was stuck in a lost decade, where they gave zero returns for many years. Well, that's true, but again, if you are a long-term investor, you wouldn't just invest only once, right? You will still periodically dollar cost average in, right? In that case, you would have broken even a lot earlier and won't be stuck with nothing for years. So with that in mind, there are 3 things that you can do to come out ahead of this. 1. Make sure you periodically dollar cost average. Just ignore all the noise and invest consistently. But at the same time, keep some cash on the sidelines so that if a crash did come, you'll be able to buy the dip. 2. Don't always look at the market. Like you got look, no look, the market is going to just do its thing. In fact, the more you look, the more anxious and probably psychotic you'll become. So don't look and just trust the process. And lastly, if you are afraid of volatility, you are probably investing with money that you can't afford to lose, or you are taking way too much risk. In that case, you may need to do some rebalancing by allocating some money into other safer asset classes like bonds, money market funds, or even diversify your holdings globally so that your portfolio can become a lot less volatile. Yes, the return may not end up as good, but at the very least, you will achieve your goal of growing your money safely for retirement. So in short, there's nothing much to be worried of lah. Just continue to invest and what big.